Will there be a soft landing, a hard landing, or no landing at all? This question seems to be on the minds of almost every business sector. If you ask 10 different economists, you'll likely get 20 different answers. However, Jamie Dimon, the CEO of JP Morgan, recently weighed in on the matter, suggesting that the likelihood of a soft landing is relatively low, potentially half of what the general market expects. Here's what Dimon had to say in an interview with the Wall Street Journal.
I'm not looking at a year, I'm not making a forecast. I'm trying to say, what are the range of possible outcomes? A lot of things in the future inflationary, the green economy, the remilitarization of the world, obviously the deficits, which basically aren't going to go away as far as the eye can see. The odds of a soft landing, the market kind of prices in 70%. I think it's half of that. As a business person, I try to be prepared for all of that. Just a little cautious. It looks a little bit more like the 70s to me. And I point out to a lot of people, things look pretty rosy in 1972. They were not rosy in 1973. So don't get lulled into a false sense of security because the today looks okay, that tomorrow's going to be okay. So just trying to separate the two. And I think some of the American public looks at it like, what are they getting? Mm-hmm. So if you go to rural America or inner cities, I'm not sure they feel like they're being lifted up.
Jamie Dimon's comments align with predictions that inflation will remain stubbornly high, interest rates will stay elevated for an extended period, and GDP growth might decline, possibly even turning negative. For instance, consider this exchange on Bloomberg discussing the timing of potential rate cuts.
And joining us now is Parametrics' Nisha Patel and Allspring's Noah Wise. And I'm going to make both of you play the rate cut game with me for a minute. Nisha, if you think about how early the Fed can possibly start to cut, when would be your earliest estimate at this point?
I would say September would be the earliest. June is definitely off the table.
How about you, Noah? Do you think that that's even possible given what we know with the data so far?
September is possible, but not likely. We think November is much more likely, or possibly even later than that.
So we're seeing predictions that a soft landing might not occur. Let me know your thoughts in the comments below. Now let's examine some of the data behind these predictions. For instance, inflation is struggling to reach the Federal Reserve's 2% target. While many other countries aim for a 2-3% target, the US specifically targets 2%. The core PCE deflator, which the Federal Reserve closely monitors, sits at 2.8% year-on-year in the latest reading, with the headline PCE deflator at 2.7%, up from the previous 2.5%. This indicates a struggle to reach the 2% goal. Additionally, headline CPI inflation is at 3.5% year-on-year, with core CPI inflation at 3.8% year-on-year, both significantly above the 2% target. This difficulty in achieving the final reduction in inflation means the Federal Reserve will be intensely focused on achieving the remaining 1 to 2% disinflation.
June rate cut definitely off the table. I think the Fed is going to have to shift their language to be a little bit more hawkish, kind of supporting the fact that they need to see more data before they follow through with cuts. At the same time, they're in a tricky spot. They don't want to shut that door completely, right? I mean, we just kind of took our turns of predicting when that rate cut might happen, with at least maybe one happening this year. They want to just make sure there's that language and that door open and slightly open to allow for that to happen. And that's going to be the tricky part for the Fed.
Which could compel rates to stay significantly higher.
Inflation data has been clearly problematic this year. We've gotten a series of above expected numbers. What that's done with the Fed is that has pushed them back. They haven't gotten any closer to their first cut in December. They were hoping for 3 this year. The most recent dot plot also pointed to 3. Unfortunately, the data hasn't supported that. So 6 months later, we think that the Fed is still in the same place. That tells us that they're still 6 months out. This brings elections into the picture. We would argue that the Fed is not inherently a big risk-taking institution. Instead, we think that what they really want to do is focus on their independence, and 25 basis points here or there isn't going to move the needle. That likely puts them behind the election rather than getting out in front of it and risking that independence.
The latest GDP reading was relatively mixed. Real GDP increased by 1.6% in the first quarter of 2024, below the expected 2.2%, yet it remains in positive territory. However, this growth is notably lower than the 3.4% growth observed in the fourth quarter of 2023. The GDP report also highlighted high inflation, with a reading above 3%. This indicates decelerating GDP growth, a very tight labor market, and inflation levels higher than the Federal Reserve's target. These factors contribute to predictions that interest rates might not be cut until September or even November. Initially, economists anticipated rate cuts as early as March, which was then pushed to July, and now further delayed. The proximity to the election in September makes a rate cut less likely, as the Federal Reserve aims to maintain its appearance of independence. Despite these challenges, the economy continues to move forward. Jaime Dimon, for instance, noted that the overall consumer situation is stable, albeit with some concerns. Now, if you like this video, check out this next video right here.